Should you sell or hold on to the company stock that you're being gifted, whether it's through just extra compensation by your company or they're giving you an employer stock purchase plan? You have scenarios like restricted stock units, RSUs, or ESPPs, employee stock purchase plans. And you also have employer stock option plans, all sorts of things that companies want to incentivize employees to work harder and help the company grow. But the problem is, as you get more and more of this company stock, you build up for a relative portion of your whole portfolio of your investments. A pretty big part of it becomes all tied to that one company stock. The big question is, should you hold it as it keeps going up, or should you be selling it out over time to lower that risk of one company? So today we want to talk about what you should be doing if you're consistently getting more and more company stock from the company that you're working for. I'm Nick Grose.
I'm Peter Grose.
And we're financial advisors with Grose Wealth Management in Fairfax. We're a fiduciary family office here in Northern Virginia, serving clients in the Northern Virginia area and around the country. And Peter has run his own independent practice for almost 30 years now.
Since 1994.
Peter has seen some horror stories of people running into situations like this in the past. And we want to break down what you should be doing if you're being gifted company stock for the employer that you're working for, and diversification strategies to slowly sell some of that off so you're not taking on that huge amount of concentrated risk.
Yes. And so I've had the examples, as Nick said, that I say horror stories, not necessarily, but a good example was General Electric. General Electric was a big company. I mean, it was probably one of the strongest stocks in the American stock market history. And, only to have a client retire with it. And it was like very hard to get him to separate with a portion of it.
Because he had a sort of emotional tie to it, right?
Exactly.
He worked there for many
He
years.
thought the stock was such a great thing. He saw it appreciate as he accumulated it and I was faced with the idea of what we call the standalone risk, that any company can falter or fall. And we, fortunately, with the different clients I had, one in particular, we diversified massively and we were rewarded when we saw the stock tumble. On the other hand, another client thought that he had enough other wealth only to see his GE just deteriorate, and it was really hard on him. But anyway, that, and then we see other stocks where we see companies with clients we have where the client has a stock that really we should know better than to hold on to it because the company was too, not that strong or well-known a company. When the client saw it go up and up and up, they want to keep it going. And then when it starts falling back, they don't want to get rid of it. They think it's going to come back like Jimmy Mac or something. Anyway, go ahead, Nick.
Yeah, no, I mean, it can be tough for people, especially if you've worked for a company for many years, or say you had a parent or grandparent worked for a company for many years and was given a bunch of that stock and then you inherit it. You can have a sort of emotional tie to this one company. You
Right.
worked so hard for them, you earned a living, you got a pension, you built up a whole 401k with that company, and you can kind of feel an emotional tie. And it's also really tough, especially when you just see the stock price keep going up. And that's what happens in a lot of these cases.
That's right.
But the problem is that when it comes to the 100-year history of the stock market, individual stocks can come crashing down and go bankrupt. We've seen this happen in the past many times, but the overall broad stock market of thousands of companies where new ones are coming in and older ones are falling out and going bankrupt, individual companies can crash and go down to zero, but the overall stock market, for at least the last 100 years, doesn't do that. It does have dips along the way, but it has that slow, consistent return of 8 to 12% or so.
I refer to it sometimes as the train that always gets to its destination. It gets there, and you just have to. Sometimes the curves are look dangerous, but you'll get to your destination.
Yeah, and we even have for our clients, we've got, for compliance purposes, a form that they have to sign if they have at least 15% of their overall portfolio is invested in just one company stock. And it's a form signing saying, I'm aware of this concentration risk. That's what we call it when you have so much risk tied to one holding. You can think of it like, for someone, if their entire wealth is just in the one home in which they live, that's a ton of risk. And you're not very diversified. Only one piece of property in one location in the US is very similar to just owning one individual stock, hoping that it's going to keep going up.
Right. And that's it. You might find somebody with a tax strategy. Say, well, yeah, I know I got 15, 20% in this one stock, but the cost basis is so low. And if I can just an older, very noble father could say, well, when I pass away, it'll get a stepped up basis, only to see it start deteriorating right before he dies in value. And so you wonder if you were penny wise and pound foolish.
Yeah, so the big thing is that the overall stock markets recover from drops in short-term bear markets or anything like that, but
Mhm.
sometimes individual stocks do not. The reason when you want to invest for the long run that you want to invest in a diversified portfolio of thousands of different companies is because you're taking a more calculated risk. Yes, owning a huge chunk of just one individual stock or like one individual cryptocurrency can give you the potential for huge astronomical returns. But the amount of risk you're taking is just, you don't get paid off for it. That amount of risk of losing it all, to being diversified in the overall stock market provides you a better trade-off for the risk and reward that you're taking. And that's why, I mean, Warren Buffett, his plan for when he passes away for all of his wealth is to be, I think I remember reading that it's going to be like 90% just overall in the US stock market and then 10% into short-term fixed income. I think it was one of his shareholder meetings or something. That's what he plans to do with his long-term wealth after he's gone. So now we need to figure out if you want to diversify out of your stock that you've been getting gifted from your company as a part of your compensation, whether it's restricted stock units or employee stock purchase plans or employee stock option plans. There's all different forms that you can get gifted this stock. But when and how should you be selling out of it? And then what do you do with the money after you sell out to try to lower your risk and not have so much of your overall net worth into one individual stock? Two important things. The first one just comes down to you have to set up a plan going forward. You can't just try to be timing the market because it's just so impossible. Trying to pick the best days when the stock is at its high and trying to sell on those days, but then trying to figure out, oh, should I wait a little longer? Could keep going up, or being scared to not want to sell when it's been going down for a week.
Sorry.
You need to set up a systematic plan when these stocks that you're being gifted, say you get them every quarter or once a year or something, you should set up a plan that once you've gone past two important deadlines that you do sell off certain chunks of it. And the two important deadlines to consider are one, your long-term capital gains rate. So you need to hold the stock for at least 1 year so that you're not getting taxed at ordinary income rates
Right.
or short-term gains. Rather, you want to get that long-term capital gains when you sell it,
Right.
which is for most people around 15% tax on that for
Right.
federal.
And that's a little different than waiting for a stepped up basis from death when you just have to wait 12 months for long-term capital gain treatment. That's an important one to take into account.
The other part is you want to look into your stock plan where, like, for your company for how they're gifting you that stock and figure out if there's other rules surrounding it, like holding period terms. Often they'll have something called qualified disposition, say that you need to hold it for at least 18 months or 2 years before you can sell it in order to get a more favorable tax treatment. So you really need to look into the rules of your actual restricted stock unit or employee stock plan to see what are the rules surrounding it to make sure you're getting the favorable
Right.
tax treatments with that.
And that's very important.
So for some strategies for selling out of this company stock, I mean, a very simple basic strategy that anyone can implement is once you've come up on that 1 year period for long-term capital gains, or maybe it's a few more months after that to make sure you follow the rules of the stock plan. But once you sell it, you could just take those proceeds and invest them into a more diversified portfolio of some ETFs or mutual funds and just get that money put to work still for the long term for yourself while getting it much more diversified and not just in one company stock. That's one way to do it, but there's other ways as well. You can look into things such as separately managed accounts, which what they do is called direct indexing. So pretty much instead of just selling the stock, taking your long-term capital gains and then buying into diversified index funds, you could get into a direct indexing strategy, which pretty much follows the same idea. But what you're doing is you're taking the stock and putting it into a portfolio with a fund manager, and they're buying a bunch of individual stocks that make up an entire index. Take the S&P 500, for example. You could take your stock, say you're working for Tesla and you're getting a bunch of Tesla stock. You could take a chunk of it that you're ready to start to sell off, put it into one of these direct indexing funds, and it will buy shares of all the 500 stocks in the S&P. And then as those stocks are going up and down every day, it can take advantage of tax loss harvesting. So when one stock is down a little bit, it can make a sale there to get some capital losses for you. And then as it's doing that, it can build up capital losses so that when at the year end, when you sell off some of your company stock, like Tesla, for example, you will have some losses there to offset those gains. That's a nice strategy that a lot of people can use, the direct indexing strategy. So another strategy as well, this is usually more often for people that have a very significant amount of company stock, say like $1 million or more that you have, and you need to kind of diversify out of that huge amount.
Right.
And this would be going into a hedge fund and using leverage to take long and short positions to really drive some capital losses to offset all those gains in that company stock. And those sort of strategies are doing borrowing on the money that you have invested. So you take like $1 million of your company stock, put it into one of these hedge fund strategies, and then they can use leverage borrowing against that $1 million value to take long and short positions to
hopefully get you some returns and get you losses. So it can work very well for you.
And these are much more advanced strategies that really require a pretty big minimum investment to get into, but they can really help limiting a lot of that tax risk. Because if you've got $1 million in Tesla stock over the last 5 or 10 years, it's just gone to the moon. So you have a ton of capital gains that you're going to need to be paying if you sell it. So finding ways to harvest some losses to offset those gains can really lower your tax bill.
That's right.
So final thoughts, and to close it out, if you're constantly getting your company stock being gifted to you, you need to realize that you're taking on so much risk, because not only are you building up a large portion of your overall portfolio in just this one company's stock, and your portfolio is going to be way more volatile going up and down each day with the movements of that one stock.
Right.
You're also getting your income from that company. So if the company starts going down, not only is the stock price going to drop, but you could be at threat of losing your job and losing your income. So you're taking on so much risk that you really ought to set up a systematized plan to schedule when you're going to be selling off chunks.
And this doesn't necessarily mean something you just received. It could be that you received stock from a company you left 10 years ago and you have it there and it's been doing really well, and you're thinking, you don't want to overthink that. It is still standalone risk, and things can change and go against you rather than in your favor.
Yeah. So the one big lesson is stocks, owning individual companies and having that as being a big portion of your portfolio can have huge risks, and they can go down and go bankrupt. But the overall stock market, you can look at over 100 years of data, it doesn't go down to zero. It has bumps along the way, but it will provide the consistent return with taking a more calculated risk and not taking on too much excessive concentrated risk in one company. So talk with a tax or financial advisor about strategies you can use to set up a systematic process and plan to make sure that you're not taking on too much risk with one company.
Nothing stated in this recording should be considered financial advice. Always consult with a financial, legal, or tax professional.